Welcome to The Deep Dive. We're the place you come to get the signal from the noise in crucial earnings calls. Basically, the shortcut to being smart about this stuff.
Exactly.
And today, we are tearing into Vince Holding Corp, ticker VNCE, their Q2 fiscal 2025 results.
Yeah.
And look, if you follow Apparel, you know this wasn't just another quarter. This was, genuinely a fundamental re-rating event. Caught everyone completely by surprise.
It absolutely did.
Yeah.
And looking at the call, our mission today is pretty clear. First, we got to summarize this massive shift in profitability Vince just pulled off.
Right.
And second, really dive deep into the specifics, the disciplined operational moves they made, especially, their aggressive tariff mitigation strategy. That's kind of driving the whole investment thesis now.
It's a real case study, isn't it? Margin strength, just powering through that top-line softness.
Totally.
Okay, let's hit those numbers that shocked everyone first, because that's where the story really kicks off. This wasn't about selling more stuff.
No, definitely not a revenue story. It was, like you said, a profitability masterclass.
So the big one, adjusted earnings per share.
Yeah, came in at an almost unbelievable 38 cents. Now, you got to remember, the consensus expectation was actually for a loss of 8 cents per share, negative 8 cents.
Wow.
So that's a 46-cent beat. Just staggering. Analysts flagged it. I saw numbers like a 575% EPS surprise.
Incredible.
That kind of beat, it takes more than just luck, right? That's execution.
It certainly is. And just to hammer home how much this was about margins, let's look at the top line, the revenue.
Sure.
Came in at $73.2 million. Now, that was a modest beat. Consensus was around $72.9 million, maybe a bit higher.
Right, basically in line.
But still, it was down 1.3% compared to last year. So revenue dipped slightly.
Yeah.
But the real engine, like you said, was the bottom line. You see it in adjusted EBITDA, too. More than doubled to $6.7 million.
Up sharply from $2.7 million a year ago. Huge jump.
Okay, but we should probably pause here. There's a bit of accounting nuance, right? The GAAP versus non-GAAP thing.
Yes, absolutely. Good point. We should clarify that for you, the listener. The reported GAAP EPS number was actually much higher. It was 93 cents.
93 cents versus the 38 cents adjusted. That's a big difference.
Huge difference.
Okay.
And it's almost entirely due to one thing, a big one-time cash infusion. They got $7.2 million from the Employee Retention Credit, the ERC.
Ah, the ERC. Can you quickly remind folks what that is?
Sure. So the ERT, that was a refundable tax credit from back during the pandemic. It was designed to help businesses keep employees on payroll.
Right.
Getting that cash now is obviously great for their balance sheet, great for liquidity, but it's not operational. It's a one-time benefit.
So not repeatable.
Exactly. Which is why management, and definitely the street, everyone wisely focused on that adjusted EPS number, the 38 cents. Because that number shows the true health of the underlying business, without that unique tax boost.
Got it. So strip out the tax credit, and the real success story is purely how they managed costs and pricing. Okay, so the real deep dive starts now. The margin expansion. How did they pull this rabbit out of the hat?
It is all about gross margin. That's the key metric here. It expanded to 50.4%.
50.4%.
Yeah, which is a powerful 300 basis point increase compared to last year.
Yeah.
And why it increased, the sources of that gain, that's the key to understanding if this can be sustained.
Okay, so what were the big levers they pulled?
Well, they had two huge tailwinds working for them. First, they got a massive 340 basis point boost just from favorable product costing, meaning cheaper inputs and higher pricing.
Okay, so cheaper to make and they could charge a bit more. That signals some real pricing power.
It does. Their customers, who tend to be more affluent, accepted those slight increases, and their supply chain costs improved. That's a great combo.
What was the second tailwind?
This one's maybe even more impressive, actually. They gained about 210 basis points just from lower discounting.
Ah, pure discipline.
Pure retail discipline. Management kept promotions really tight. They successfully stretched out the full price selling season. They didn't just panic and slash prices to move inventory.
Okay, but here's where I'm genuinely impressed. They got that huge 300 basis point gain in gross margin.
Right.
Even though they were facing some serious headwinds, weren't they? Tariffs were still a drag.
Oh, absolutely. Tariffs cost them 170 basis points, and higher freight costs hit them for another 100 basis points.
So wait, that's 270 basis points of drag combined?
Yep, almost 3 cents on every dollar of revenue lost just to tariffs and freight. They had to overcome that just to stay flat on margin year over year.
So the fact that they overcame that 270 basis point drag and still ended up 300 basis points ahead.
That's the proof. That's the ultimate proof of their strategic execution and that discipline we keep talking about.
Okay, let's look at the customer side then. Where did that full price discipline actually pay off? Which channels?
The direct-to-consumer segment, DTC, was strong. It grew 5.5%. And that was both their physical stores and their e-commerce business contributing.
Yeah.
So that tells you the brand health is solid. Customers are buying at full price.
But the wholesale segment was down 5.1%. Now, if they're executing so well, why let sales slip there? I think some people hearing this, even with the amazing margin story, might look at that overall revenue dip and pause.
That's a fair point, a fair challenge. Management talked about this directly on the call. They framed that wholesale softness as mostly a deliberate timing issue.
Deliberate. How so?
They actually delayed some of the fall order shipments by about 3 weeks. They said they did this specifically to recalibrate their supply chain because of all the uncertainty around tariff policies. It also let them stretch out that high margin spring selling season a bit longer. So it looks like they chose margin certainty over just booking that early wholesale revenue.
That timing decision, that probably ties into their inventory levels too, right? I saw inventory was up $76.7 million compared to $66.3 million last year. Normally, rising inventory is a bit of a red flag.
Usually, yeah. But here, they said it was entirely intentional. Strategic.
Strategic how?
2 main reasons they gave. First, just the higher carrying value of the goods.
Yeah.
Because of those tariffs we mentioned, the same item costs more on the books.
Okay.
And second, a strategic choice to bring goods in earlier, ship them earlier, basically building up a bit of a buffer stock ahead of potential, reciprocal tariff extensions or other supply chain hiccups. De-risking Q3, essentially.
Makes sense. And we shouldn't forget the balance sheet cleanup either. They paid down a good chunk of debt.
Yeah, long-term debt balance down by $23.3 million, now sitting at $31.1 million. That's significant progress.
And combined with having, over $42 million available on their revolver?
$42.6 million, yeah.
It just means they have way more financial flexibility than they did a year ago. Their credibility with lenders, with the market, it seems truly restored.
Which brings us nicely to the elephant in the room. The biggest challenge they face going forward, navigating this tariff tightrope.
Yeah, management used the phrase confidently cautious, which, frankly, sounds like the only sensible way to be right now with global trade being so unpredictable.
Totally agree. And they were very explicit. They warned investors that they baked roughly $4 to $5 million of estimated incremental tariff costs into their outlook for Q3.
4 to 5 million expected drag in just one quarter. That's massive for a company this size.
It is. But, and this is the key operational story now, the mitigation strategy is what matters. Vince expects to mitigate about 50%, half of that substantial Q3 tariff headwind.
Okay, mitigating half is still a huge task. How are they planning to do that? What are the tactics?
They laid out 3 main things. First, aggressively moving country of origin for manufacturing, getting out of higher tariff zones.
Right, diversifying.
Second, really tough vendor negotiations, trying to share that cost burden.
That makes sense.
And third, they're using what they call surgical price increases. This is important. They're not just slapping an extra 5% on everything.
No blanket increases.
No. They're evaluating it style by style, product by product, understanding the price elasticity, making sure they don't tick off their core customer with sudden jumps. It's smart retail psychology.
The sourcing diversification piece, that number really jumped out at me. They're targeting a maximum cap of 25% exposure in any single country going forward.
Yeah.
And they mentioned that as recently as Q1, they had a roughly 60% exposure just to China.
60% down to a target cap of 25% across all countries.
In less than a year. That kind of supply chain rerouting, that's an insane operational lift. Shows incredible focus from management.
And that kind of pivot, that agility, that's why the market is suddenly paying so much attention, right?
Yeah.
It shows they can adapt.
So looking ahead, their Q3 guidance reflects this balancing act, the tariff drag versus the mitigation efforts.
Exactly. Net sales expected basically flat to up low single digits. So not huge growth expected on the top line yet.
Still managing expectations there.
Right. Adjusted operating income guided between 1% and 4% of net sales. And adjusted EBITDA between 2% and 5% of net sales.
And it's worth pointing out that guidance includes plans to start reinvesting a bit, right?
It does. They mentioned starting to restore some of that top-of-funnel marketing spend they'd pulled back earlier in the year, trying to rebuild awareness.
And they also touched on that longer-term growth idea. leveraging their platform, their supply chain know-how, to potentially bring other brands onto their system.
Yeah, that's the future optionality piece. But first things first, execute on Q3.
And the market's reaction certainly showed belief in the current execution. That stock surge was wild.
110% surge on absolutely massive volume. We're talking over 60 million shares traded that day.
Compared to a normal average of, what, maybe 60,000 to 260,000 shares?
Exactly. Just off the charts volume. It was complete re-rating by the market.
And remember, this huge positive print came right after the NYSE accepted their business plan back in August, the plan to regain their listing compliance.
Right. So it feels like the narrative has shifted. They survived the liquidity scare. Now it's all about proving this operational excellence is sustainable.
Okay, which brings us to our favorite part of the deep dive.
You know the drill, folks. We're here to discuss, analyze, inform. We dig into the details for you.
But we are absolutely not registered financial advisors. This is purely for entertainment, for informational purposes. Do your own homework, your own diligence before making any investment decisions. Seriously.
Couldn't say it better myself. Okay, disclaimer done.
Let's talk about that 100% plus run-up. The stock went absolutely vertical. It blew past near-term analyst targets. Noble Capital had just lifted theirs to 450, and the stock sailed right by that.
Yeah, that surge felt almost entirely momentum-driven. Just a flood of new buyers chasing the story.
Which means it probably overshot fair value in the very short term.
Almost certainly overshot fundamentals intraday, yeah. The catalyst map for Q3, the next big event, it really centers entirely on one thing. Can they actually deliver that 50% tariff mitigation they promised?
And can they sustain those margin gains into the holidays?
Exactly. The risk right now is that the market got a little too excited, too optimistic about how easily they can just absorb that $4 to $5 million tariff hit in Q3.
So thinking about that volatility, we came up with an outrageous but plausible short-term trade idea.
Okay, let's hear it.
How about a synthetic short using put spreads?
Okay, interesting. Let's break that down quickly for anyone not deep in options trading. A synthetic short with put spreads. Basically, you're betting on a controlled, relatively small drop in the stock price, or at least that it won't keep rocketing up. And you're defining your risk.
Right. The idea is to capitalize on potentially inflated short-term volatility. We bet the volatility contracts a bit and the stock maybe retraces back towards that recent analyst target, maybe around the $4.50 mark you mentioned.
So the logic is the market's immediate massive reaction has already priced in perfect execution on tariff mitigation for Q3.
Before they've even reported those results.
Exactly. So you're essentially betting that some skepticism creeps back in as people really digest the scale of that Q3 tariff challenge, that 4 to 5 million drag.
The goal is purely to exploit that immediate, maybe overdone momentum flow. Given that 100% plus move, a short-term pullback or consolidation seems plausible before the next earnings call comes along to actually confirm if the mitigation worked as planned.
It's a tactical play on the immediate aftermath of a huge news event. Outrageous, maybe, but plausible, given the chart action.
That's the pitch. Okay, so let's recap the whole deep dive. The core takeaway from the Vince holding call wasn't about selling more clothes.
No, it was about selling fewer clothes, perhaps, but selling them much more profitably.
They delivered a really clean profitability beat, driven by that operational discipline, aggressive cost management, and what looks like a very effective, proactive tariff mitigation strategy.
It really raises a fascinating question for you, the listener, to think about. The market is clearly betting heavily that Vince's operational skill can beat these macro headwinds like tariffs.
Yeah. So if they can successfully cap that sourcing exposure at 25% per country, remember, down from 60% exposure so quickly, and if they do manage to mitigate half or more of those Q3 tariff costs.
Does this business model become kind of a template, a playbook for how other contemporary apparel brands need to navigate this volatile global trade environment?
And thinking even longer term, don't forget that platform idea. What happens when they really activate that? Leveraging their infrastructure, their supply chain, their systems to bring other, maybe smaller brands to market.
That's potentially huge optionality built on the foundation of this new financial discipline they've demonstrated.
Lots to chew on there. Plenty to watch as we head into the back half of the year for Vince.
Absolutely. Well, thank you for joining us for this deep dive into Vince Holding Corp's surprising quarter. We look forward to digging into the next set of crucial earnings with you soon.